Hi, I'm Todd, and this is the On Wealth and Progress podcast. This week, we'll explore the question of whether we are currently in a stock market bubble. If you're interested in balanced, factually supported commentary for a better future, you've come to the right place. Last week, what simultaneously swept America off its feet, and many of our concerns at least temporarily under the AstroTurf, was the news Swifties everywhere have been waiting for. The voice that has long consoled lost souls through songs like Dear John, Picture to Burn, and just in case you still can't read the playbook, We Are Never Ever Getting Back Together, is now betrothed to her Kansas City chief in shining armor. Okay, cynics, we know you're out there. Arms folded across your chest, toes tapping to the beat of the start of the NFL season and an upcoming album are, well, let's just say, not entirely coincidental. Well, okay, the rest of us will admit that Tay-Tay knows there's more to spin than the way old records used to go around a turntable. And the whole Kelce clan has merged its way right off the field and into commercial wonderland. We'll spot you that, all right? But listen here, you wretched rationalists. This isn't the time for all that. Just give the Swifties our moment, will you? Is that too much to ask? So let's break out the champagne and fill the glasses with a bit of the bubbly. Amidst the chaos and confusion of daily life, it's nice to have something happy and uplifting to celebrate. I mean, if someone who's been publicly jilted more times than a day trader in a bear market can find true love, or at least a great way to kick off a new season and a new era of songs, maybe there's hope for the rest of us, right? And speaking of bubbles, some of you may have noticed that after a couple of weeks on related matters, we still haven't gotten around to directly popping the question on many an investor's inquiring mind. Are we in a stock market bubble? So let's take a knee, polish up our history lessons from the past couple weeks, and after a short break and with Mr. Market as our witness, apply what we've learned in the past couple weeks to this important question. Like what happened with the S&P index, remember, an index is created from a group of stocks to track overall market trends in the 1920s and the technology-oriented NASDAQ index in the 1990s. We are currently in a bull market environment, which, as we'll see in a moment, is different from a bubble. In fact, annual stock price increases for the past 5 years of about 14%, and remember that's annually for the S&P 500, and 17% for the NASDAQ index are eerily similar to what happened in the 1920s and 1990s bull markets, respectively. As noted previously, while not necessarily signaling a bubble, bull markets, which are sustained periods of increasing stock prices, do create a sense of optimism that stocks will continue rising, and can lead investors to think that bear markets, which are sustained periods of declining stock prices, are a thing of the past. In addition to bull market thinking, it's also quite clear that, just as happened in the 1920s with automobiles and consumer appliances, and in the 1990s with the internet, the artificial intelligence revolution has led to a modern form of the new era thinking that can make ideas about fundamentals, like corporate earnings and valuations, the price-earnings multiples that company stocks trade at, seem almost as anachronistic as the notion that radios were once a technological breakthrough. So there are similarities between where we are today and the conditions that ultimately led to bubbles in the 1920s and 1990s. And anecdotal indicators like skyrocketing IPOs, and remember, an initial public offering is when a company first lists its stock to trade on the markets. So skyrocketing IPOs and meme stocks that run up on social media hype also provide reasons for caution about a bubble forming. But in and of themselves, these conditions alone do not mean that a bull has turned into a full-blown bubble. Let's look at rate cuts. As we discussed last week, in both the 1920s and the 90s, ill-timed Federal Reserve rate cuts were the spark that sent bull markets into full-blown bubbles. Remember, a bubble is when stock prices and valuations soar well beyond recent norms to levels that ultimately are unsupportable and they collapse. In the 1920s, a number of Federal Reserve officials were deeply concerned that the New York Fed's September 1927 rate cut would lead to dangerous market speculation. And later, Fed member Adolph Miller testified, "In my judgment, the rate cut resulted in one of the most costly errors committed by it," he means the Fed, "or any other banking system in the last 75 years. End of quote. Rather than learning from their mistakes, however, the Fed has since more or less stuck its head in the sand about the impact of its policies on bubbles. Nevertheless, the current Fed's fear of rekindling inflation has so far led it to resist pressures to cut rates. And at least so far, we have not seen the type of skyrocketing stock prices and valuations that turned those past bull markets into bubbles. So let's compare what happened back in the 1920s and 1990s to where we are today. From the Fed rate cut in early August 1927 to the peak in September 1929, the market soared by over 100%. And as this happened, the PE ratio for stocks roughly doubled from its prior 5-year average. Likewise, from the Fed's ill-timed rate cut in mid-October 1998 until the peak in March 2000, the NASDAQ index skyrocketed by over 225%, and once again, PE multiples on infotech stocks more than doubled. Over the past 2 years, however, the S&P 500 has increased by only about 40%, which is high, but not like what we saw in past bubbles. And according to Yale economist Robert Shiller's data, its trailing PE ratio of 29, while high by historic standards, is only a bit above the average from the last 5 years. And likewise, the NASDAQ index has appreciated by only about 22% over the past 2 years. So again, nowhere near like the 100 or 200% increases we saw in the last 2 bubbles that we got into. And according to Yardeni Research, the forward PE ratio for infotech stocks is currently roughly 30, which again is high by historical standards, but only a bit above the trailing 5-year range. So, we are not seeing the kind of dramatic increases in stock prices or in valuations that we saw in the 2 bubbles that we've studied so far. So let's take a short break, and then we'll come back to conclude our discussion of current market conditions. Based on our analysis of the last 2 bubbles, current markets do not appear to have taken on the characteristics of prior bubbles. Specifically, we haven't seen the type of suddenly skyrocketing prices and valuations that characterized the bubbles of the 1920s and 1990s. Nevertheless, both the bull market trend of steadily increasing stock prices that we've had recently and the new era thinking that has accompanied the artificial intelligence revolution have increased the risks that a new bubble could emerge. To paraphrase Santayana, those who ignore the lessons of history are doomed to repeat them. In this regard, investors are well advised to be mindful of the risks of jumping into the markets, or especially into narrow sectors of the markets, with both feet in circumstances like these. Most investors will do best by working with a trusted financial advisor who can A. help them avoid falling prey to Mr. Market's dangerously contagious swings between greed and fear, B. follow a sensible long-term investment plan that also avoids the common tendency to bet too much on new era themes, as in like, bro, this AI thing is a lit rocket, either get on board or get left behind. And C. avoid especially dangerous practices like buying stocks on margin, which means buying stocks with borrowed money. Furthermore, the Federal Reserve would be well advised to pull its head out of the sand about the risk that its policies could trigger yet another bubble. And the administration should give due consideration to how a bubble and collapse could derail much of its agenda. Now, as Mark Twain also famously observed, history doesn't repeat itself, but it often rhymes. And while there are a number of similarities between current conditions and past periods of excess that led to bubbles, this doesn't mean that we're destined to end up in another bubble. Even if we are fortunate enough to avoid a full-blown bubble, however, today's historically high PE ratios are likely to weigh on future investment returns, which is something we'll return to in a future post. Today we face important challenges, but none that are greater than those we have overcome time and again throughout our storied history. Here's to hoping your day is as bright as America's future. If you found this helpful, please subscribe and recommend it to at least one other person. If you'd like to learn more and to find links to my free On Wealth and Progress newsletter and my book, please visit my website, toddsheetswriter.com. And also, please remember, the preceding content is for informational purposes only, based on information available when it was created and believed to be reliable. It is not an offer or solicitation, nor is it tax or legal advice, and does not consider your financial circumstances and objectives and may not be suitable for you. Readers and listeners are encouraged to consult with a financial advisor who can consider your individual circumstances before making any investment decisions.